It has been a wild month for stocks on Wall Street, and it's likely to get even wilder. Between schizophrenic corporate earnings, dismal economic data, financial reform, and the continuing saga in the Gulf of Mexico, investors don't know which way to turn. Some say we're about to see the start of a huge bull market. Some say stocks are about to fall back to their 2009 lows, and you should take advantage of the bear market. Some say you should employ strategies to protect yourself if the market goes up, down, or sideways. This week on Money and Markets, we'll cover all the bases. We'll discuss the relationship between the economy and stocks and find out why that relationship isn't always as clear as it seems. We'll get market outlooks from 3 different experts and learn why things may look a lot different in September than they do in January. And most importantly, we'll tell you how to make money, regardless of whether you're looking to protect your investments or make a killing. That's all coming up right now.
From our studios in Jupiter, Florida, Weiss Money Network presents Money and Markets. And now, Jamie Holmes.
Hello, everyone. Well, July started with a 2-week rally that sent the Dow Jones Industrial Average up more than 7%. Now, at that point, many of the so-called experts in the financial news networks were heralding the start of a bull market that would last the rest of the year. But Mike Larson has been warning of a downturn in the stock market for months, and, well, he hasn't changed his opinion. Mike, why have you stayed so bearish on the market despite this recent rally?
Jamie, it's because I'm looking at the fundamentals. I don't care if you're talking about consumer data, housing data, manufacturing data, employment data, it's all trending lower. So I'm convinced that what we saw at the beginning of July was just another bear market rally.
Okay, Mike, but let's take a listen to what Jim Cramer said on CNBC a little earlier this month. He said the rally was, quote, totally and absolutely justified and that we have seen the lows for the year. Now, you disagree. Why?
Well, it's like what we've talked about here. I mean, the economic data we're seeing is unambiguously pointing to a double-dip recession. Now, granted, from time to time, there's a bit of a disconnect between Wall Street and Main Street, but it's only a matter of time before the stock market catches on to what's happening in the real economy. You want to buy stocks when you're in the depths of a recession, not when you're about to head into one.
Okay, Mike, why has there been such a disconnect between what we see in the economy and what we see on the stock market?
I think a big reason for it has been the monetary policy of the Federal Reserve. By just printing money, the Fed can create asset bubbles. It threw liquidity into overdrive heading into Y2K, and that helped cause the technology bubble. Then it kept interest rates too low for too long and helped create the biggest housing bubble the world has ever seen. And now it's helped create an artificial stock market rally coming out of the last recession. I mean, the Dow Industrials rallied more than 70% from the lows in March 2009 through recently. But that rally was mainly due just to the Fed adding liquidity rather than any underlying economic strength. That's why I call this the bought and paid for recovery. The economic stimulus package and the Fed's loose monetary policy have been propping up asset values all over the place. But I don't think that strategy is going to be successful for too much longer, and you only need to look at the economic data to see why. Consumer spending accounts for 2/3 of our total gross domestic product, and consumers are hurting badly. The Conference Board's Index of Consumer Confidence plunged in June, with the gauges that track present conditions and expectations both falling to the lowest level in 3 months. That lower confidence is translating into slumping retail sales. Sales fell more than 1% in May, then another 0.5% last month. That was the first back-to-back decline in more than a year, and much worse than economists expected. Another area of the economy where we see extreme weakness is the housing market. Now, the government was able to prop up real estate with a tax credit for new home buyers for a while. But after that credit expired, we saw what was behind the curtain, and it wasn't pretty. New home sales fell more than 32% to the lowest level in U.S. history. And home construction was just as bad. It plunged 17%, the biggest monthly drop in nearly 2 decades. What about manufacturing? Well, that's in bad shape too, and not just in the United States. The Baltic Dry Index measures demand and pricing for global shipping services. It recently dropped for a stunning 35 days in a row. That's the kind of implosion we haven't seen since the 2001 recession, and it tells me that global trading and economic activity are both grinding to a halt. Now let's put aside these backward-looking indicators for a moment and look forward instead. I've talked about the Economic Cycle Research Institute before, and I'll talk about it again. That's because its weekly leading index is one of the most reliable measures of the economy. It's done a great job at forecasting periods of growth and periods of recession, and it's done so well in advance. Sure enough, it's tanking again. The last time the index dropped like this, the economy went into recession just a few months later. I expect that to happen again, and I expect the stock market to follow the economy down.
Okay, Mike, you say that the fundamentals of the economy are telling you the stock market is heading lower. I want to play devil's advocate again with you, though.
Sure.
Jim Cramer is also pointing to the broader economy to make his argument. Now, he said a sustainable rally would happen if financial reform was finalized, Spanish banks stabilized, unemployment declined, BP plugged the leak in the Gulf of Mexico, China's economy had a soft landing, and then the euro stopped falling. Now, we have seen most of those things happen. So why do you think that it doesn't matter?
Well, first of all, we actually haven't seen unemployment really fall. And from where I sit, most of the other factors really don't have any lasting connection to stock prices at all. My indicators, on the other hand, have a quantifiable direct relationship to the market. And I'm not just looking at forces in the macroeconomy. I'm also basing my projection on technical factors. Take the Dow Transports. They're usually a good leading indicator of the broader market. And that index has been trending lower for a couple of months and recently hit a new low. You can see another extremely bearish sign if you look at a recent chart of the S&P 500. Now, earlier this month, the 50-day moving average dipped below the 200-day moving average. That's called a death cross. Now, anything with a death in its name can't be a good sign, I'm sure you can imagine. And the same thing happened with the NASDAQ a few days later. So it's these signs, combined with what's happening in the overall economy, that are telling me the stock market's just not the place to be.
Okay, Mike, you think what we saw earlier this month was just a bear market rally and not the start of some sustainable uptrend, right?
Oh, absolutely. And it's not even very unusual. You know, people tend to think of bear markets as just this straight line down. But in actuality, bear markets always feature huge short-term rallies, and that's because of short covering. Short sellers tend to react quickly when even the mildest bit of good news comes out. So that makes for a lot of volatility, which is exactly what we've been seeing this month.
Mike, big question. How low do you think stocks can go?
Sure. Well, I think we have to look at some key support levels. Let's call it 9,700 on the Dow and about 1020 on the S&P 500. If we fall below those levels, there won't be anyone left to support the market once you've cleaned out all the short sellers. Now, in that case, I think we could see the Dow fall back to around 8,000 by the fall and ultimately all the way back to the 2009 lows. That would be about 6,500 on the Dow or 666 on the S&P. Now, I know that may seem like an extreme scenario, but if you consider that many economic indicators are already at the levels they were at during the depths of the last recession and at the time when stocks were that low before, I think it's very reasonable that we head that way again.
All right, Mike Larson, thanks so much for being here.
Thank you.
Okay, if the market is headed for another downturn, how can you protect yourself? Nilus Mattive is an expert on income investing, and he joins us from his home in Chadds Ford, Pennsylvania. He has some ideas for us. Nilus, do you agree with Mike's outlook for stocks going forward?
Well, Jamie, not to sound flip, but I really don't care what stocks do next. I mean, you know, over the next 6 months, my focus is on income and steady returns. So I'm going to employ the same strategy whether the market goes up or down. Having said that, the economic indicators certainly do look negative, and I think it's clear we're going to continue to see a choppy market.
Okay, so in that case, Niles, how would you position yourself?
Well, given the volatility in the market, I might want to have a couple positions that would be ready to go if the market rallies. But for the most part, I would tell investors to skew defensive. In my Dividend Superstars portfolio, I'd say we're about 80% defensive right now, with just a few positions that are slightly more tied to the economy. They're long-term plays that I don't mind holding through another dip. But if we're facing a recession and the type of market conditions that go along with it, then you want to have a large stake in cash and you want to be more investing in conservative stocks.
Okay, so what type of stocks would you be focusing on then?
Well, they're the companies we've talked about previously: consumer staples, utilities, healthcare, and pharmaceutical stocks. They tend to hold their value when most other sectors are falling because they're generally things people can't do without, like household goods or electricity. I wish I knew what's going to happen in the stock market over the next 6 months, but for income investors, it's more important to have a longer-term perspective. Look back over the last 10 years. The stock market has gone way up and way down, but the end result is that the Dow is close to the same place now as it was in 2000. So it's been kind of a lost decade for many investors.
Okay, Niles, if stocks have been so stagnant then why not focus on safer asset classes like, say, maybe treasuries, or ones that you think will have a higher upside like commodities?
Well, it's smart to diversify into some of those areas as well, but I think unless you want to go ultra conservative, you have to have at least some exposure to stocks. So my recommendation would be invest in companies that pay dividends because they'll give you steady returns whether the broader market goes up, down, or sideways. But either way, I do think defensive companies should make up a substantial portion of your portfolio.
And we're going to be talking about one of those defensive plays in just a couple of moments. Niles, thank you so much.
Thanks, Jamie.
Okay, coming up next, picks and pans. In addition to one of Niles' dividend-paying stocks, we'll get investment ideas for surviving another market downturn from this week's other guests. We're also going to hear about the other side of the coin. With so much volatility, you might want to know about picks that will net you gains in the event of a short-term rally. We've got you covered there as well. Money and Markets will return in a moment.
America is in trouble. Federal and local governments owe over $123 trillion. New debt is escalating at the rate of $183 million per hour. That's $1.6 trillion per year. Bond prices are plunging, and that could drive interest rates sky high, triggering an even deeper recession. If you are worried, and you should be, download Mike Larson's blockbuster new report with urgent investment recommendations to help you protect your wealth and profit. Don't delay. Do it now.
Welcome back to Money and Markets. We have heard from Mike Larson that stocks are likely to head much lower over the next few months. And Nilus Mattive told us that regardless of what happens in the market, you should focus on stocks that pay a dividend. Now let's dig a little bit deeper into those recommendations in our Picks and Pans segment. As Niles has said, there are dividend stocks that track closely with the overall economy and those that hold up well regardless of what the economy is doing. Linear Technology is one stock that would benefit from an uptick in the economy and the market. It makes semiconductors that are used in all sorts of electronic devices, so it's heavily dependent on strength in the technology sector and consumer spending, but it also pays a solid dividend. Another dividend stock that Niles recommends is much more defensive, and that's Pfizer. That stock, along with the other pharmaceutical giants, would likely get a boost from any stock market rally, but it would also protect you in the event of a downturn. If the market does break to the downside, one of the sectors likely to get hit the hardest is banking. Financials are heavily tied to the economy because a recession means fewer loans for cars and homes and, of course, more delinquencies and defaults on mortgages and credit cards. That's why Mike Larson is recommending you bet against the financial sector with the ProShares Short Financials ETF. ProShares also offers a similar fund with double leverage, but that's more a trading vehicle for short-term bets, while SEF is a longer-term investment. On the other side of that coin is the sector those funds are shorting, the financials. Mike recommends you stay away from banking stocks, and especially funds that bet on a basket of those stocks, such as the SPDR Financial Select sector, ticker symbol XLF. It's been trending lower along with the broader market since April, and it's going to likely continue to go that way. We'll be talking to Larry Edelson in just a few minutes, and he suggests playing the market in a similar way. In order to take advantage of a falling market, he recommends buying the ProShares Short S&P 500 ETF, ticker symbol SH. If you want to bet against stocks, that's about as simple as you can get. For every 1% the S&P 500 drops, this fund goes up by 1%. But what if the market surprises us and breaks to the upside? Even if that happens, Larry says that the best way to take advantage isn't to bet on stocks, but on gold. Gold has consistently outperformed stocks, and Larry thinks it's going to continue to do so, even in the event of another bull market. That's why he recommends that investors put up to a quarter of their liquid net worth into gold and gold shares. The easiest way to do that is with the SPDR Gold Shares ETF. Ticker symbol GLD. It closely tracks spot gold prices, and it's backed by the most physical gold of any similar exchange-traded fund. Investing in gold mining shares is as easy as buying GDX, another ETF that holds stakes in all the large cap miners. But be careful with this one. While the price of gold bullion and the GLD fund are likely to go up no matter what happens in the broader market, gold mining shares are as dependent on stocks